everybody in the world was predicting recession coming. So therefore, as a contrarian, the risk reward trade is to play for not recession. Whether there's actually recession or not is almost irrelevant to me. It's really what the market does, you know. So I believe that until the idea of this recession is given up on, the market is going to go higher. And once they give up on this recession idea, then the market will top.
The S&P 500 is up 8% year to date, and the Nasdaq, up 16% during the same time period, has had its best quarter since 2020. But this market rally is not yet over, says our next guest, who has been calling for a market rally since last year. Jason Shapiro, principal of JS Trading LLC, thinks markets will continue grinding higher until everyone stops being so bearish. Jason considers himself a contrarian trader, and we're going to find out exactly what that means. Jason, welcome to my show, The David Lynn Report.
Thanks for having me, David.
You are a contrarian trader. We're going to find out what that means. Jack Schwager interviewed you for his awesome book, Unknown Markets Wizards, and he asked you about your origins. I'm going to share this one story with the audience and branch out from here. You said that after your first job after college, which was an HSBC job, which you didn't like, you met this woman, Jackie Chan, who gave you $100,000. She used to be at Morgan Stanley, and you grew that account to $700,000. And back then you were in your early 20s. How did you do it?
I think like only a person in their early 20s could do, which is just be ridiculously levered and get lucky. You know what I mean? It was a bull market at the time. We were trading the Hang Seng Index futures, and this was in 94. I don't remember the exact number, but I think the Hang Seng went from about 7,500 to 12,000 in 6 months. And, I was young and new to trading. And that's what sort of is very typical of young, new traders, what they do. You catch a bull market and you catch it leveraged, then you make a ridiculous amount of money. And I would add to what you're saying that I turned $100,000 into $700,000 is once that bull market ended, I turned $700,000 into about $7,000. So, which is also very typical of, a young, over-leveraged trader who got caught up in a bull market. So
you told me that, you were a young trader catching the bull market. How do you know, or how did you know back then it was a bull market? Did you, I mean, obviously everything's going up, but did you know it was going to continue going up? What were the indicators you were looking at?
It was just the market was going up every day, and money was pouring into the Hong Kong market. And I'm not going to say I knew it was going to be a bull market. I was just trading it the only way I knew how to trade it, which was trade it like a bull market. That was the only market I had seen up to that point in my young life, and so that's what I knew, and so that's what I did. And I didn't know when it ended, obviously, because I lost all that money and more back. So. Sometimes you just you catch it at the right time, as a lot of people I think did post-COVID, and have learned this same lesson. I know there's a lot of people out there who made a lot of money post-COVID and have probably lost all that money back and more since then, last year. I think my story was pretty typical of a new trader. And I've said many times, I think the worst thing that can happen to you long-term is that when you start trading, you make a bunch of money. Because then you don't really learn the lessons that you need to learn. You think that you're good at this and you think the market's easy. And I think that neither one of it is true. You're not good at this because no one is. And the market is not easy. So you learn these lessons when you make a bunch of money when you start, and they come back to get you later.
Jack Schwager's book, when he introduced you in his opening paragraph, and I'm just going to read it. Jason Shapiro achieved consistent success as a trader by learning to do virtually the exact opposite of what he did instinctively in his first decade of trading. So I guess you learned from your mistakes. What did he mean by that?
Yeah, I think that's what he meant by I learned from my mistakes. I think that my trading, when I first started, and maybe my first 10 years or so, was very similar to what everybody else does. We go through we're all sort of fit in the normal distribution curve of the human race, and we all go through very similar processes and learning processes. You're looking at fundamentals, and then you're looking at, technicals, and you're trying to put all these things together. You start trading momentum. A lot of people go towards, And you kind of go through this whole learning curve, which is the same thing I went through. But what I found was after 10 years, while I had a lot of volatility and I had a lot of times where I made money and lost money, I got nowhere, right? So at some point, you have to decide, do I really want to get down to figuring out how to actually make money doing this over time, right? Or do I just want to sort of have this as a hobby and have fun? So I kind of had made the decision at that point that this is what I want to do for a living. So I really had to get down and get serious about how to figure out how to make money. And it becomes very simple where if what I had done to that point, everyone goes through this, is lose money, then why not just do the opposite of that and make money? Okay. And it wasn't quite that simple, but that's the general principle of that thought process. And it goes for what I do now, it goes another step, which is that if the vast majority of people lose money over time doing this, then why can't I try and figure out what the vast majority of people are doing and do the opposite and make the money that they are going to lose?
Okay, so let's talk about that strategy and then why you're still bullish. I mean, you just said that the worst thing that somebody starting off trading can do is make money. I see what you're saying, but I guess if you keep losing money, you're not going to have any more money to trade, right? So you got to start making
But you will
some
learn
money.
your lessons a lot quicker. You will learn the lesson, and you're losing money with a lot less money, and you're
Right.
losing money early, so you have a lot more time to make it back, right?
Yeah.
So
Well, I
really,
guess
I know
that's
it
why.
sounds like a strange thing to do. The best thing you can do is lose money when you start, but from a longer term perspective, I promise you that is the best thing that can happen to you.
Or just sidetracking for a bit, for a newbie trader watching this, do you recommend that he uses real money to start off with, or like one of these virtual simulators, you can use any amount of money online?
I think that if you really want to judge your psychology in trading and how you react, you have to use real money. I mean, simulators are great and you can try it just to get your feet wet, but you're never really going to know how you're going to react to these situations until you have real money on the line. What I would recommend is that they think about how much money they want to put into this if they're new and cut that in about a quarter and start doing it there, and lose money with a small amount of money first and then learn your lessons and then figure out how to make money.
We spoke a few months ago at the end of 2022, right? At the end of the year, you said we're going to get a big rally. Many people thought you were wrong. You weren't wrong. Let's talk about this rally. Is it over?
I still think that the stock market has some upside to take care of before it's over. I don't necessarily think that's going to happen immediately. We're coming into the summer, which tends to be more of the sell in May and go away type of thing. But I am certainly still long stocks as I have been all year. And I don't see anything at this point that is taking me out of that position. So I still think that there's still upside to go and that has to be completed here.
I remember some of the criticism you got when we spoke last time wasn't just your market call, but I think I asked you about the economy. And back then, you weren't super bearish on the economy. You had said, we're not entering a super doom and gloom scenario like some others were predicting. Have you changed your outlook on the economy since 3 months ago, 4 months ago?
I think my ability to predict the economy remains the same as it was 3 or 4 months ago, which is not particularly good. I'm not any kind of great economist or anything. I understand the basics of economics, having gone to school and paid attention to that, but my ability to predict the future of the economy is no better than, or worse, I would say, than anybody else's. My thought process at the end of the year last year was that everybody in the world was predicting recession coming. So therefore, as a contrarian, the risk reward trade is to play for not recession. Whether there's actually recession or not is almost irrelevant to me. It's really what the market does. I saw a guy who has been bearish all year, and he's a public guy, so he talks about his stuff all the time. And the market was flying in his face and flying in his face, and he was short and short and short. And he came out and said, the truth is I've been right about everything this year except the stock market. Okay, that's wonderful. So he's been right about the economy, and he's been right about this, and he's been right about that. but who cares? You know what I mean? He's been short the stock market and that's been going up. And that's the only thing that matters as a trader, right? I'm not trading the GDP number. I'm not trading a contract on the CPI number. I'm trading the S&P 500 or whatever, right? So that's what I need to predict. So that was the idea about the economy really at the end of last year was everybody was so discounting in this recession that was coming that to me it was over discounted and the play was to play no recession. Um, and, so far that's been the case. Does that mean there's not going to be a recession? Doesn't mean there's not going to be a recession. Some of the numbers are looking pretty weak right now, although some of them are not looking weak. So I can't really tell you what the economy's, I can't tell you what anything's going to do in the future, but personally, I can't really predict whether there's going to be a recession or not. I just play the markets. I believe that until the idea of this recession is given up on, the market is going to go higher. And once they give up on this recession idea, then the market will top.
Well, they'll give up on it once it actually happens, and then it dissipates. I mean, the Federal Reserve actually just announced a week and a half ago at their meeting minutes that they think a mild recession could hit, and they think it's likely to hit by the end of the year. So even the government officials are saying that too.
When's the last time they got it right? A and B. I just, to me, the way I saw it and the way that I still think is that the surprise is to the upside. And if you really want to get into it, and I'm not predicting this is going to happen, I'm saying this is one possibility that people don't seem to want to believe. And this is the issue with over discounting something. We kept hearing at the end of last year from CEOs. Okay, I remember one specific CEO for one of the big casino companies was saying, his quote was like, "We are preparing for the coming recession, but we have not seen any evidence of it yet." Okay. So if everybody, and this is just one guy, but this is what a lot of people are saying. If everybody is preparing for the coming recession, what do you do if you're preparing for the coming recession? Well, you cut back on spending, right? You cut back, if you're a business person, you cut back on building inventories because you know that there's a recession coming, right? So you are preparing for it. And then what happens if it doesn't come? Well, now you have to rebuild inventories, right? Because you prepared for recession, it didn't come. Now you're underinvested and you have to start to invest again and rebuild your inventories. So in that situation, not only don't you have recession, you end up having a boom, right? And to me, if that happens, that's when everybody will give up on this recession idea. That's when everybody will chase the stock market higher because the earnings that they thought were going to be much weaker because of the coming recession end up not being much weaker and end up being stronger. So now they can chase the market higher. And that's when I will start to give it back to them.
Okay, but Jason, why is it that over the last 4 months, the markets have been rallying despite what you said? Everyone was bearish, super bearish, predicting a recession. I don't understand this sort of juxtaposition. You got rallying stock markets, but people thinking the economy is going to suffer. Why?
That is why, because they're all short. So the market rallies when everybody's short, right? Because they get squeezed out. It's just like the people I was talking about that are underinvested in the real economy. People are also underinvested in the stock market. I mean, go out and find me one person who is massively leveraged long the stock market here. I can't find that person. I'm sure maybe they exist somewhere, but everybody I hear on TV and all the commentators I hear, they hate it. Now they might pick and choose. Okay, you got to be in energy, you got to be in consumer staples, whatever. But people do not think that this stock market is going higher, and therefore they're just getting squeezed. It's a consistent squeeze of shorts. That's just, as a contrarian, that's how I see how the market works. The market goes up because people are short and underinvested, and the market goes down when everybody gets too long. To me, it's really in a way that simple. So that's why it's going up. You're saying, why is it going up despite the fact that they're all bearish? I'm saying it's going up because they are all bearish.
I know some people are probably thinking this right now as they're watching you, so I'm just going to ask it for them. How do you know, Jason, that you were right, quote unquote, right over the last 3 months and not just lucky?
I think I am lucky. Okay, but I'm playing odds. You know what I mean? They don't always work. I have losing trades all the time. I trade across a lot of different markets, and I trade exactly the same way across all of them, be it stocks, be it commodities, be it currencies, be it fixed income. And sometimes right isn't necessarily to me the right word. Sometimes it works, sometimes it doesn't. But when it works very big. And when it doesn't, I lose very small. And that's really what trading is about for me. It's not about predicting the future because you don't know the future. It's about playing odds. It's like if you play blackjack and you count cards, right? Okay, you know when the card count is in your favor. Doesn't mean you bet at all when it is, right? But it means you start to increase your bets. So you increase your bet, the dealer flips a 10 over and gets 23 while you're sitting on 17 and you win. Well, how did you know that he was going to flip a 10 over? You didn't know, right? You're just playing the odds because you counted the cards. So that's to me the answer to that. Was I right or was I lucky? I'm just playing the odds. So it's part luck, but I'm just playing the odds.
How do you know that everyone is bearish? I mean, look, the obvious answer is you go on the news and you watch channels, CNBC, maybe even my channel. I've interviewed a lot of bearish people. The sentiment on the media has been bearish. Are there technical indicators though that you look at that would show you that everyone's feeling a certain way?
So I use the commitment of traders data very extensively, which is data that comes out on the US futures markets and the positioning in those markets, which again doesn't always work, but does show you when people are very one-sided on a positioning basis. And we came into this year and people were very one-sided short the NASDAQ, which is why I was long the NASDAQ. And then about, I don't know, 5 weeks ago or so, they had actually chased the NASDAQ and gotten out of those shorts, but now they had been shorting the Dow. So I got long the Dow. And then as of last week, they had gotten out of some of those Dow shorts and they had got super short the S&P. So now I'm long the S&P. So I look at this commitment of traders data, which shows me positioning in the futures markets across these assets. And that helps me determine whether people are super long or super short or just neutral. And on top of that, yes, that can be confirmed by what you hear on TV, what you hear in the media. I'm sure, without even having seen all of your interviews, that the vast majority of people that you have on here are bearish. Okay. Because the vast majority of the people that I see on all these interviews are bearish. So why would, the subset of the people that you have on be any different? And quite frankly, it's what makes sense. You have to be bearish because of what's happening, but that doesn't mean that it's right. You know what I mean? The market climbs a wall of worry. And the reason the market climbs a wall of worry is because when everybody's worried, everybody's short. And when everybody's short, the market rallies.
I need to come back to this. I'm trying to wrap my head around your philosophy here. You just said it makes sense to be bearish, but you're doing the exact opposite. I mean,
Yes.
your results speak for itself, but I just
Yes.
don't understand why would you do the opposite of what makes sense?
Because the market doesn't make sense. Okay.
Okay.
It never has. It never will. And that's what being contrarian is all about. And that's why when you get back to the original question, I started doing the opposite of what I did my first 10 years. My first 10 years, I tried to do what made sense and it didn't work. Okay. So after that, I decided let's try to do what actually makes money. Right. And what it turns out, I think what makes money is really doing the opposite of what makes sense. Because in particular, when everybody can see what makes sense, because then it's discounted in. The market is a discounting mechanism. So if everybody knows to be bearish, then they're short. And if they're all short, the market has a good possibility of going up. And certainly the upside is going to be more than the downside. There's no guarantee the market can go down, but the upside is going to be a lot more than the downside. And that's what you want to be in, trades that pay you more when you're right than pay you when you're wrong. My trading has less than 50% profitable trades. So the game is not getting it right. The game is having bigger payoffs when you're right than when you're wrong.
All right, so let's talk about your outlook again. So you're still in this rally. You're long. When are we topping out, or what's the level you're looking at for a top out?
I don't really look at levels necessarily. It's not really up to me. It's up to them. When these people start getting unbearish and when they start getting bullish, that's when I think we will top out. Be that in a week, a month, or a year. I don't know. That's kind of up to them. When we spoke earlier at the end of last year, the idea that everyone had that I was trying to fade was that the first half of the year was going to be bad because it was going to discount the coming recession. And then the second half of the year was going to be good because it was going to discount coming out of the recession. That was the consensus view back then. So now maybe it'll be the opposite. Maybe by the end of the first half of the year, which is only a couple months away at this point, they will have given up on that idea. And then we can get short for the second half of the year. I won't know until that time comes, but that was the idea coming into the year. So let's see if that holds out.
Do you support the idea that the markets are usually forward-looking, and so this rally is actually projecting the economy to do all right? I mean, we're not getting into the economy again. We're not talking about economics, but maybe markets are thinking that things are going to be okay.
Maybe, but then why is the bond market doing what the bond market's doing? You know what I mean? And why, with the yield curve inversion and all that, because that market is not saying that. That market is saying recession, right? So I don't necessarily think that. I think that the market is going up because people are way too short.
At what point do you think people are going to be done covering their shorts?
I think they'll be forced to. Like trend followers are already starting to cover because they're being forced to because they're trend followers. And if the market's going to continue to go up, they're going to be forced to cover their shorts. So that'll be the first group that will get out of shorts. And then the fundamental group will also be forced at certain points to cover shorts just because of P&L reasons. But how will they ever get long? It is a mystery to me here. But again, I think it's maybe if the economy doesn't go into recession and maybe it does this thing where it actually starts to accelerate to the upside, then maybe then they can get long fundamentally. I don't know. It's a very strange time because people that are fundamentally bearish, which are pretty much every fundamental person that I know or that I listen to, how are they going to get fundamentally bullish if the market's 10% higher than here? I just don't know. I could see them getting fundamentally bullish if the market goes down and takes that last year's low or something, then maybe they can start to. But if it keeps going up, how are they going to get fundamentally bullish? I have no idea. But like you and everybody else, I am watching and listening with very much interest. We will know when they do it because suddenly everybody on your show and everybody else's show will start justifying the bullish move through fundamentals.
Do you follow the VIX at all? I mean, the VIX is still at what, like a multi-year low?
Okay. It's at a multi-year low, but I mean, I've been trading for quite a while. There was a period of time for probably 8 to 10 years where the VIX traded between 8 and 13. So the VIX is, this is this recency bias. 18 or 17, whatever the VIX is at now, compared to 25 to 30 is low. But 18 or 17 compared to 9 or 10 is not low.
But is volatility an indicator for you for how the markets are feeling going forward?
Not really.
No? Okay. People can be volatile for all sorts of reasons. All right. So you are going to come back on my show and tell us exactly when people flip-flop, and we'll get your take on when to sell. But for now, you're in this rally. How are you playing this rally then? Are you just long the overall index? Are there specific stocks or sectors that you like that you think will do better than others?
I only trade futures, so I don't do individual stocks. But I am long right now the S&P futures. So that's my play. And as far as the stock market goes, that's my play.
All right. And I know you follow currencies as well. The DXY has been weakening over the last couple of months since we spoke. Is that something that is going to continue, this weakness?
I got short the British pound yesterday. So I'm starting to think that the dollar is about to go back into rally mode. I have a gut feeling, and hopefully it's wrong, but I have a gut feeling here that I'm a little early here, and if I am, I will get stopped. But I have setups to short both the British pound and the euro. So I'm kind of waiting until they confirm that for when I should do it. Like I said, yesterday I did the pound, but I think this idea that the dollar is dead, Whereas 6 months ago, the cover of The Economist or whatever was how the dollar was dominating the world. 6 months later, now that the dollar's come back down, we're getting this whole rhetoric about how the dollar's dead and China is going to take
Yeah,
over
I'm
with their
hearing that
currency.
every day I log in, it's de-dollarization. Dollar's going to collapse. China's taking
Correct.
over.
Correct. So we're getting very close, in my view, as a contrarian, um, to being the dollar going up, right? Sometimes I'm a little early on this stuff. So like I say, maybe this pound trade's a little early. I don't know. But the de-dollarization story, I think, it's just funny because 6 months ago, they were all bullish as hell of the dollar and the dollar was taking over the world. Now, all of a sudden, all we hear is de-dollarization, right? I'm starting now, and as time goes on, we'll probably be more so looking to fade that de-dollarization idea, which kind of coincides with the fact that I think that gold is a short as well. So if the dollar is going to go up, good chance gold goes down. So these things are kind of lining up together, which I always like. When the different markets line up together like that, it's always a stronger signal.
I love getting a trader's take on this because it kind of goes against everything a trader does or thinks. But I interviewed Eugene Fama, who is a Nobel Prize winner for his work on the efficient market hypothesis. He was the one that created this. Well, not created this. There were others before him, but he was the one that popularized this idea. But he basically thinks that markets are efficient, meaning that markets price in all publicly available information at any given time. And so it's a futile effort to try to time trades or even try to be an active manager because eventually you're just going to lose. And eventually, you're better off just buying a passive index, leaving it alone. I know that's not really your style to be a passive investor, but even as a contrarian, you have to think that if the markets are pricing in all information at any given time, what's the point in even trading, right? I'll let you comment on this.
I think it's a great discussion because I agree in a lot of ways with the efficient market theory when it comes to price. Right, this is what we were talking about earlier. If you're going to tell me that you are going to buy or sell a security because the price has done this or that, I'm going to tell you that that's a ridiculous thing to do. Okay. What I try to do is I'm not looking at price. I'm looking at participation. So while the markets are probably pretty darn efficient over time, human beings, when acting in mass, are not efficient over time, right? You've seen it throughout history, right? When human beings all jump on a bandwagon just because everybody else is doing it, that's where problems exist, right? Be it war, be it whatever, right? And that's what I am doing. I'm waiting for everybody to jump on a certain market in mass, and then I'm going the other way, right? So that's where I think the inefficiency is. And Fama, I don't believe, really gets into behavioral finance very much, but that's more of a behavioral finance theory. But I think from his point of view, from just typical finance and typical efficient pricing, I agree with that. I don't think that you're going to get an edge by picking this stock or that stock because you think that it's going to do this or you think it's going to do that. I think that that's impossible to do, and it's been proven over time that that's pretty much impossible to do because nobody does it.
I'm just curious as to why you think that looking at price patterns from before, historical price action doesn't necessarily work.
Historical price action, meaning like charts and all that stuff.
Yeah, if you look at a chart and then it's rallied 20%, it's created this, flag, bull flag, bear flag. Is that something you look at?
No, I think it's garbage.
Okay. Is
I
that
personally don't. It's not, and I'm not going to say it hasn't been something I've looked at. I have
right?
read just as many technical analysis books as everybody else, right? I mean, you name them, right? Murphy, Edwards, McGee,
Sure.
whoever it is, right? I've read them all and I've gone through them all and I've traded them all and I think it's garbage.
I mean, it's what Fama said as well. He used the word junk, but I mean, I've interviewed technical traders who claim it works. You I got both sides of the eye. You claim that it doesn't work. Have you tried it yourself? Is that something, a technique you've tried?
Sure, I've traded technical charts before. I think that the thing about trading is that, and the thing about human beings is that you're biased, right? And so therefore, if you're a good trader and you're using good trading techniques, which means you're taking bias out, right? Which is very hard to do, and you're using good risk management, then anything can work for you, including trading charts. If that's what you lean on, charts, and you have good trading habits, that can work for you. I can hand those same exact charts to somebody that has bad trading habits, and then we'll make the same trades, and it won't work for them. Two people can trade the same charts. One will make and one will lose, right? My favorite chart recently for this year, and my example of charting for this year, has been there was this downward sloping trend line on the S&P that everybody was talking about earlier in the year, okay? Everyone was talking about it, and everyone was bearish, so they were interpreting it as bearish. The market was bumping up against the trend line, and you had to sell it against that trend line, and that was the bear trade. And then it broke through the trend line. And then they all said, oh, well, it's a false breakout. Okay. And it went up, and then it came back down. And then they all got bearish again. Well, they were bearish anyway, but they got bearish again. And then it went back up. And now what they've done is they've taken that trend line and they've just moved it up. And they say, oh, well, here's the trend line now. And they've completely forgotten about that old trend line. Because that old trend line it's broken out of, they're bearish. They don't want to hear about breakouts. They want to hear about resistance. So they just move the trend line up and they say, oh, now here's the new trend line. Here's the new resistance, right? It's bias. So, and it's silly to me. And what that other trend line proved was, if you go back and look at it, hey, it was this perfectly formed trend line. Well, the market traded above and below it after everybody saw it, because it takes 3 spots to see it. Here's the high, here's the first test, here's the second test, right? Okay, now you see the trend line. Once everyone saw it, it went above and below that trend line about 5 different times, which showed that that trend line was a completely irrelevant number, okay? But it looks interesting going into it, and it's something to talk about. So that's how I feel about that stuff. Now, I know some guys that are on my Discord page that are very successful trading some chart patterns. You know, they trade head and shoulders patterns, and there's a guy on there who likes to trade the Elliott wave stuff and seems to do a very good job of doing that. But I think it's more about the fact that he has good trading habits than he has any kind of great ability to use charts to predict. If that's what helps him, great. I use the COT. That's what helps me. Okay. I'm sure there are other people that use the COT that suck at it because their trading habits are not there.
Remember 2 years ago when GameStop was pushed up by a bunch of people on Wall Street bets? Is that, sure. Did you get in on that?
No, I wish I did though.
Well, why not? I mean,
I don't trade individual stocks.
Oh, okay.
So but
I'm just extending the same kind of
it's the
logic
same kind of,
here.
Look, it's the same kind of concept.
Right.
GameStop was and I believe still is a completely bankrupt company, right? Now, if they're not bankrupt now, it's only because the stock went up so much and they were able to play stock and raise some money, right? But going into that, they were a bankrupt company, right? Who goes to game stores anymore, right? My son is a gamer. No one goes to game stores. Anyway, bankrupt company, and the smartest people in the world knew it, right? Mr. Big Hedge Fund guy over there at SAC, whatever his name was. And he was short, like more than the entire float or something of the entire market. So he got squeezed. And it had nothing to do with the fundamentals of GameStop. It had everything to do with positioning. People were way too short this stock. So when it started to run up, they got squeezed and it ran up even more and it ran up even more. And that's exactly how I approach trading the futures markets with the COT. I'm looking for that exact type of thing.
Why doesn't that kind of squeezing work for the overall market? Is it just a matter of size and liquidity? I mean, I think it does
work for the overall market. I don't think that this stock market is going up this year because of any of these other reasons. I think the stock market is going up this year because people are way too short. Now, it's not going to squeeze up like GameStop did, right? Because that would take a ridiculous amount of money, right? I mean, how much money would it take to squeeze the S&P up, 800% in 3 months or whatever? It doesn't exist. But on a relative basis, that's kind of how it works.
So we talked about the stock index and the dollar. Give us another trade that you like this year.
Those are my main trades right now: stock index, dollar, and then the things that go with the dollar, like gold. I'm looking to be short, the metals.
You think $2,000 we're due for a pullback?
The gold, you're saying?
Yeah, gold. Yeah, gold's at 2,000.
Yeah, I mean, I've shorted gold twice in the last 5 weeks, and I lost money both times. I got stopped both times. And now I am not short, and now it is going down. So there's a good chance that it continues down now that they've squeezed me out. I have the trade on, like I say, hopefully in other ways where I'm short British pound, but certainly with gold down 28 points today and the British pound barely down, that's not been a great thing for me. But yeah, I think that gold is at the very least not a buy here. I think on a risk reward basis, you don't want to be long gold here.
All right. I'm going to close off on this one final question. Do you trade trend reversals? This is another interesting idea that I've heard recently from an economist. The idea of trading fractals. So what he told me, and if I can summarize, is that when markets are volatile and there's a lot of different price movements, that's a more complex market. There's a lot of different movements in different directions in a short amount of time. When things go straight up or things go straight down, the complexity of that price goes down, meaning it's less complex. It's just a straight line up or straight line down. Whenever you have a complete collapse of complexity, when things move in a straight line, it's time for a trend reversal. Do you agree with that?
Depending on the positioning, I agree with that. That's all I trade is trend reversals. That's all my stuff does is pick sort of tops and bottoms, right? Not always successfully, okay? But that is what I do. So yes, but I don't look at it as trend. Trend is more of a price thing, right? By definition, a trend is a price thing. I look at it as a participation thing. So when everybody gets super long, yes, then I'm looking to go the other way. Now that coincides a lot of times with the market going straight up. Nothing like a market going straight up to get everybody super long, right? So a lot of times that's similar, but sometimes not so much so. Like in stocks right now, people are not chasing it higher. So that's why I think it's going to continue higher. And once they do, then I will be looking to go the other way. But yeah, that's where I live, is in that trend reversal world.
Stocks, gold, typically they don't move always in the same direction, but they did the last 3 months. Do you look at correlation? Does that matter to you?
It matters a lot to me. Yes. From a portfolio basis, it matters a lot to me. So while I lost money short gold a couple times, I've more than made it back long stocks because those are correlated trades. I like to have trades on in my portfolio that are like that. If I could be long one thing and short another thing that are correlated, and then therefore I can just play the outperformance of one versus the other. And over time, that gives me much better risk-adjusted returns. You know, in retrospect, it's like, oh, well, you should have just forgotten about the short gold and just been long stocks. Okay, in retrospect, it's all easy, right? But going into it, had everything collapsed for whatever reason, I would have lost money on the stocks, but I probably would have made money on the gold. So that's really how I like my portfolio to look. It doesn't always look that way, but I do like very much when it does look that way. It helps me sleep at night and it gives me much better risk-adjusted returns. You know, my returns tend to be a little bit lower during those periods, but my volatility is much lower. So my risk-adjusted returns go up.
All right. Well, I appreciate your insights. The trend is still intact on the upside for now for stock markets is, I think, the bottom line of our discussion. So let me know or let us know next time whenever you think this trend is going to reverse. We're all waiting for your updates.
We'll try to let you guys know. I'm not the ultimate, picking every single turn, every single market guy, but I do try to. But I will certainly let you know when I see a change, at least from the things that I look at.
I did say finally, this is my last question, I promise. Do you think the media is in itself a contrarian indicator? When 100%. You see like the economists saying everything's going to go south or, everything's going to be great.
100%. I 100% think that is the case. Yes. And again, not every single time, but a lot of times.
It's something I've observed too. Like, is that just because people are looking backwards and they're lagging, or is there a bigger psychology thing going on?
You write an article for The Economist, okay? The first thing that has to happen for you to write that article, you're not going to write the article beforehand. You're going to write it afterwards. So if something happens, it clicks. Hey, maybe we need to write an article about this, right? It takes you how many weeks to put that article together? You've got to write it. You've got to do your research. You've got to get it to your editor. Your editor has to go through it. He has to decide if this is something that is going to sell his magazine, right? Because at the end of the day, that's what they're trying to do is sell magazines, right? So what's going to sell your magazine? Well, a popular opinion is what's going to sell magazines, right? My stuff is not popular, I can tell you. Okay, being contrarian is not popular, right? But what's going to sell magazines is something that's popular. So if it's popular, again, everybody's agreeing with it. And therefore, there's a good chance it's going to reverse. That's why I think the whole media coverage, cover of the magazine thing works, because of that sort of dynamic.
Interesting. All right, Jason, thank you very much. I'll speak to you again soon. Thank you.
Thank you, and good luck with the David Lynn report. We're big fans, and everybody out there should support the David Lynn report. He's a really good guy. I go on quite a few interviews, and David does a great job.
Oh, I appreciate that. That means a lot. Thank you. And where can people follow your work? You have a website?
Crowdedmarketreport.com.
Crowdedmarketreport.com.
Which we're also on Twitter. We're also on Twitter. So, and I think there's a few Twitter guys that have copied us, so be careful for the real one if you do go on Twitter. But somewhere on Twitter, we're on there.
All right. Well, yeah. Click on the real one, not the imposters.
Right.
All right, Jason. Take care, and thank you for watching. And don't forget to subscribe.